What's up, guys? Welcome back to lesson 5 of our crypto crash course brought to you by the Coin Collective channel. We're gonna be talking about portfolio management and how I manage my portfolio, and there are tons of other ways you can do it, but we're gonna give you a couple resources. And then we're gonna also talk about liquidity pools, arbitrage, automated market makers, and impermanent loss. So let's start with portfolio management. How I manage my portfolio is I just use CoinMarketCap.com. It's a pretty easy to use website. They have an app on the App Store. Let's just head over to the computer and I'll explain how to manage a portfolio on CoinMarketCap. Okay guys, so we're here at the computer right now. Let's go ahead and dive in. So once you're here at CoinMarketCap.com, all you gotta do is just sign up, make a quick account with your email, and then once you've done that, you head over to Portfolio. And let's say that you just made an XRP purchase on Uphold. So let's go ahead and add some XRP to our portfolio. We went ahead and bought, say, 100 XRP. And the current price of the coin is $1.05. And we bought it today at, let's say, 12 o'clock. Just so I can show you that you can set different times just in case that, say, you bought that coin yesterday and you want to have the exact price it was at 12 o'clock yesterday. You can also do that on here. It's a pretty cool interface. And then you also paid, say, $1 in fees. You can add that fee in there just so it takes that fee into account. And just in case I have any tax information, I like to add notes to my transaction. So I'll say, Uphold, purchase, say today is 23rd November 2021. You could say it's your first purchase because that was your first purchase of a XRP. You add that transaction and your portfolio is now worth $105, and it'll constantly track the valuation of that 100 XRP in your CoinMarketCap now. So you can do this with any coin. You can add some, say, get a Bitcoin, you can add some Bitcoin in here, and now it tracks your one Bitcoin that you just bought and your $100 of XRP. And then say you were like, I don't want any more Bitcoin now. You could go in here, you click the plus button, you click sell, and then you can say, all right, I want to sell half my Bitcoin. I want to move some of this money over and diversify it into other coins. That's fine. You can track that here, selling half your Bitcoin wherever you bought that from. And then you can, there you go. It now tracks it as 28,913. You're tracking half of your Bitcoin holding and 100 XRP. Okay guys, so what I just did here is I bought 100 XRP and then I bought one Bitcoin, but then I sold half of that Bitcoin. And I showed you how you can sell assets in your portfolio here. You're not physically selling these assets. It's just tracking the value of these different holdings. So say you have some of your quant in Coinbase Pro, which is a different exchange, and then you have XRP and Uphold, and then you have some Constellation DAG in your KuCoin. In order to track all of your holdings at once, you can use CoinMarketCap to track all these holdings in one place, which is super helpful. So also guys, if you see a super cool coin that you heard of on the internet and you don't want to forget about it, let's say you just heard about Quant on the internet. You can go to Quant by simply just typing it in the search bar up here and then add it to your watch list. So say you don't have it in your portfolio, but you don't want to forget about it because there are a lot of coins out there. There currently are 14,708 cryptos, so it's pretty easy to forget about one that you just saw. So now, since I have starred this coin, it currently exists in my watch list. So I now have that coin saved. So now I've showed you guys how to add coins to your watch lists, how to buy and sell coins and track them in your CoinMarketCap portfolio, how to customize the date and times that you've bought your coins. If you want to add fees to add a little bit more detail to your buys, you can do that as well. And also, if you want to rename your portfolio, you can do that pretty easily too. You just click More, edit portfolio, and now I can name this, say, Coin Collective's portfolio. Bam. Super easy to use. You can, once you build your holdings, you can obviously zoom out and see how well you're doing over 90-day frame, 30-day frame, 7-day frame, or even all. So again, guys, this is just tracking your holdings. This is not for physically buying these assets. This is after you have purchased these assets on different exchanges and you want to have an easy way to track the valuation of all of your holdings. Okay, so that's basically the basic idea of portfolio management, and we've linked the website, CoinMarketCap.com, below. You also can get their app on the App Store. They have a great platform. Let's go ahead and move into liquidity pools, arbitrage, automated market makers, and impermanent loss. These are some very important things to understand when interacting with decentralized exchanges and doing decentralized swaps of different cryptocurrencies. All right, so I'm gonna explain to you guys automated market makers first. So automated market makers are the way that you can swap from Bitcoin to Ethereum in a decentralized exchange like Uniswap or SushiSwap, rather than having a traditional market of buyers and sellers on each end as you would do in a stock market. You have these automated market makers that regulate the prices of the Bitcoin and Ethereum in, say, a liquidity pool using a mathematical formula. And I know that sounds like a lot, but I'm going to explain to you how that this works and why that these decentralized exchanges are able to exist in a permissionless manner. First off, liquidity is just how much of an asset that you can easily convert into, say, cash or a cash flow asset without really affecting the market price of it. So it's really just how much cash you have on hand, how easily liquid your assets are, how quickly that it can flow. Think of it like water. A liquidity pool are assets that have been locked up in a smart contract for liquidity purposes. So it really is not that complicated. It's just some assets that are locked up so that you can swap them on a decentralized exchange. And an automated market maker is how that they automatically regulate how much of one asset over another needs to be in these liquidity pools at a given time. So in the simplest terms possible, you have an apple and you have an orange. And then say I wanted to take my apple and swap it for an orange. So I would go to a liquidity pool, and let's say that there are 20 apples and oranges in the liquidity pool, and there's a 50-50 split between them. So you have 10 apples and 10 oranges in the liquidity pool. I take my apple and I swap it in the liquidity pool into an orange. In order to do that, I am adding one apple into the liquidity pool. So now in the liquidity pool, there are 11 apples and 9 oranges. And this actually causes the price to fluctuate slightly because you have decreased the supply of the oranges in the liquidity pool. So the price of the oranges has rose slightly. And since you have increased the supply of the apples in the liquidity pool because you added an apple in, the price of the apples has slightly decreased. And of course, if you increase the volume and you're dealing with a real liquidity pool and dealing with real automated market makers with millions of dollars of two assets, it's going to be much more complicated than that. But we're giving you the simplest explanation of how a liquidity pool works, what liquidity is, and how these automated market makers allow for these permissionless and decentralized swaps to happen on these decentralized exchanges. Okay guys, so I just explained to you guys what liquidity is, a liquidity pool, and automated market makers. The next thing we're going to talk about is arbitrage. And arbitrage happens a lot in decentralized finance because in these liquidity pools, the price of these assets are locked into these smart contracts. So if you have Ethereum sitting at $4,500 In the liquidity pool, it could be a different price because it is unaffected by what the price is on an exchange somewhere, or what Coinbase says the price of Ethereum currently is. So you have an opportunity there called arbitrage. And the reason this is because the price in these liquidity pools is locked in a smart contract. So it's different of what you would see in a typical market of buyers and sellers. It's locked into a smart contract at a price, depending on the supply of the apples or the oranges or the Ethereum and the Bitcoin or whatever is in that liquidity pool at that time. Okay, so arbitrage doesn't exist all the time. It depends. There's not always going to be arbitrage opportunities. Typically, you see arbitrage when, say, an asset like Ethereum or Morpheus or Bitcoin has just spiked up and down in price really quickly. So you have the liquidity pools over here on these decentralized exchanges that have not quite corrected up or down to that new price action. That is arbitrage. So in order to take advantage of this arbitrage, you would really have to be behind your computer like 24/7. This is almost like a day trading job. You'd have to really be focusing on the markets and watching the liquidity pools on the decentralized exchanges versus the actual market price of these different assets. And what we teach you here at Coin Collective is more of having the long-term approach and holding for these different swings in the market and kind of beating this FOMO that a lot of people have. But it's still important that you guys understand how arbitrage works. And a lot of people come across it and don't understand what it means. It's just because in these liquidity pools, they have not quite caught up to the market price of whatever that asset is because someone hasn't gone in there and taken the supply of that coin or digital asset or apples out of that liquidity pool to balance out the price of those two assets. So for the next part, we're going to talk about impermanent loss. And I'm going to make something very clear. So impermanent loss only happens for liquidity providers. So people like you or I that would provide these assets for these liquidity pools, they would lose money from this. So when I just explained how arbitrage works, say when Ethereum price goes up, but the price that is fixed in that smart contract in your liquidity pool is still lower, you have that arbitrage opportunity, right? So you have other people come in and buy up that ETH until it corrects to the real market value of Ethereum at that moment. During that happening, the people that run the liquidity pool are losing money, which is called impermanent loss, due to the price difference or the arbitrage that is being taken advantage by other traders and buyers coming into the liquidity pool and buying up that cheaper Ethereum. So you have two sides. You have the arbitrage opportunity being taken by these people that see a cheaper asset because it hasn't caught up to the market value currently. And then you have the impermanent loss happening from the people that provide the liquidity in these liquidity pools that are losing money due to the price difference happening at that moment. And then normal people like you and I typically don't even deal with either of these things. It's just good to understand what they are, so when you encounter them, you can understand what someone's talking to you about. So when a liquidity provider loses money in a liquidity pool due to that arbitrage, it is called impermanent loss. And it's called impermanent loss because due to the people coming in and buying the Ethereum out of your liquidity pool, taking the supply out and driving the price of your Ethereum back up, there is a good chance that the price of your Ethereum and your liquidity pool will reach that market value and will balance out and you'll be fine. The only way it would be a permanent loss is if you exited and took your money out of that liquidity pool smart contract before the price leveled back out to the current market price of whatever asset you're talking about. Okay guys, so I'm gonna show you a liquidity pool that is very popular right now. It's called SushiSwap, and I'm gonna kind of go through the decentralized exchange and show you what it kind of looks like. Me personally, I don't really use SushiSwap or Uniswap that much because the gas fees are so high currently. I use SpookySwap for the phantom chain if I'm trying to get in on something, or I'll use Trader Joe on the Avalanche chain if I'm trying to get into some new asset, because the fees are so much lower on these DEXs as opposed to SushiSwap or Uniswap that I'm going to show you. But the idea of them is exactly the same, and the user interface is exactly the same. So let's head over to the computer. Okay, so here we are at SushiSwap. This is what the interface looks like. As you can see, SushiSwap has their own native token, Sushi. It's at $8.50. That doesn't really matter right now. This is one of the largest decentralized exchanges out there. They have $4.43 billion in total liquidity, and they have a lot of volume. This is how many liquidity pairs they have. They have 2,227 pairs. Okay, so I'm going to go ahead and show you guys some analytics so you can see what these pools look like. All right, so these are some of the largest pools right now. You have wrapped Bitcoin to Ethereum. And if something's wrapped, you're basically just pegging its value, say with this wrapped Bitcoin, so it can transact on another network. So they have wrapped Bitcoin because you can't just take a Bitcoin and transact it on the Ethereum network. You have to wrap it if you want to transact the actual value of Bitcoin on the Ethereum network. But it's still pegged one-to-one with a Bitcoin. So if you have one wrapped Bitcoin on the Ethereum network, you can go right back to one actual Bitcoin. They hold the same value. So as we can see in the wrapped Bitcoin Ethereum pair, it has $432 million in liquidity. So that's how much is locked up between these two pairs. And then you have Ohm and DAI. I love Olympus DAO. They do a lot of really cool stuff. We're going to get into them in a later episode. And these are a couple other pairs that exist out there. These are some really big tokens. So yeah, this is kind of how these liquidity pairs work. These are some really big ones. And then this is what a decentralized swap would look like if you were going to swap in a liquidity pool from one token to another. So if you're going to go from, say, one Ethereum to, let's go to Olympus. One Ethereum to 4.9438 Olympus. You have to go through a liquidity pool for that to happen. And you can't just swap like that. You have to have a wallet connected. So in this case, you'd probably connect your MetaMask wallet. You can easily get that in the Google Chrome extension store. We're going to go over that in a later episode, how you would set that up, because we're going to talk about DAOs, and we're going to talk about decentralized reserve currencies, and that's where you would get them, is you would get them from these decentralized exchanges. So here is another decentralized exchange that I actually use far more often than SushiSwap or Uniswap. This one exists on the Avalanche blockchain, which is just another coin that has their own blockchain protocol. And Avalanche has extremely cheap transaction fees. So I could swap from, say, Avalanche to USDT, which is just the US dollar pegged to a stable coin that's on the Avalanche network, for very low fees. If I was to do this on SushiSwap, I would have to pay very high Ethereum gas fees. I think right now it would probably cost you about $60 in Ethereum to make a swap. On Trader Joe, you spend virtually nothing. And this is on the Avalanche blockchain. And then SushiSwap, which is another one, same exact interface. You would connect your wallet to this decentralized exchange as well. This is on the Phantom blockchain. Very similar to Avalanche, just a different network. And you can swap from anything on the Phantom network to any different token. So let's say we're going to go from Phantom to, oh wow, they have Chainlink on the Phantom network. That's pretty cool. So we could go from Phantom to Chainlink in a decentralized exchange setting. All right, guys, so I've showed you a few different decentralized exchanges, how these kind of liquidity pools work, where they exist, and why they matter. And again, this is probably something you guys are not going to be doing all the time. As you get more into the world of cryptocurrency and trading, you may want to get on these decentralized exchanges, because if you want to get in earlier on a new project, the odds are you're going to have to interact with one of these. So there you go, guys. That's the end of lesson 5 of our crash course. Thank you guys for watching so much. We covered today liquidity pools, automated market makers, impermanent loss, arbitrage, what is liquidity, and we talked about portfolio management. So there's a lot that we went over today. So see you guys in the next lesson. Thank you.